So we've gone through and reviewed comprehensively all your basic investment appraisal techniques that you've seen in F9. So we've gone through there and seen your accounting rate of return, we've seen our payback period, our net present value and our internal rate of return. What we're going to look at now is what's referred to as advanced investment appraisal techniques. Now, I just think calling them advanced investment appraisal techniques makes them sound more difficult than what they actually are. I'd like to scrap the word advanced and just call them other investment appraisal techniques. Because what we're going to go through and look at, these other investment appraisal techniques, are first of all your modified internal rate of return. Then we're going to go through and look at your discounted payback period in the next recording. And then the recording after that we will go through then and look at your duration. The best way to go through and start looking at your modified internal rate of return is to go through there and start looking, first of all, at your internal rate of return and the limitations that there are. Now, the limitations that we have in terms of your internal rate of return are fourfold. Some of them you will remember from the days of financial management. Some of them you'll be less familiar with. The first one is looking there, based upon your internal rate of return, is that you could have multiple IRRs. So by that, what we mean is that we could have a project that has more than one internal rate of return. So here, this project could have some strange cash flows throughout its project life, and we have there 3 IRRs. Which one of those IRRs are we going to choose to be there as our investment appraisal percentage? It could mean that we make the wrong decision because we need to ensure there that your discount rate is less than your IRR to accept the project. Which discount rate are we going to choose? So there's the first limitation. Second limitation that we have is that there may be no internal rates of return. So there, what we could have is we could have a project whereby the project curve never actually crosses the discount rate axis. If that's the case, we do not have an internal rate of return. If that's the case, we can't appraise the project using your IRR. The third limitation that we have is based upon the fact that your internal rate of return is quoted as a percentage. When it's quoted as a percentage, that percentage can be read as the return on the investment. Now, if we just do a very brief example as to show that that IRR could be interpreted as the return on investment, that may go through there and help you understand the issue. Because there, if we invest, say, £100 and we get in 1 year's time £110, if we go through there and discount that back to present value, but set it to nil, because we're trying to calculate a nil MPV to be able to calculate the IRR, then what we should be able to go through and work out there is that R is equal to 10%, which is the IRR, which is also the equivalent to the return on our investment. We made a 10% return. We invested £100, we've got £110 back, so we've made a 10% return. That there is our IRR, that there is the return we've made on the project. But your IRR ignores the initial investment. It tells us that the return is 10%, but if that £100 that we invested turned out to be £100 million to get that 10% return, you might have second thoughts about investing in that project. £100 million is a lot more cash to find than just a simple £100 investment. The last limitation that we have there is one that you may not be so familiar with from the days of F9. What we have there, we have an IRR for an individual project. And what your internal rate of return goes through and does is makes the assumption that any cash flow that we generate within the project gets invested back in the business at the internal rate of return, which really in real life wouldn't be the case. If you go through and generate cash in a project, you're going to go through and invest that cash at the company's cost of capital. So what we want to be able to go through and do is look at that limitation and try and make adjustments so that it is no longer a limitation of our internal rate of return, which involves going through and calculating a modified internal rate of return. Now, the best way to look at this is to look at an example using IRR and then use that IRR example to then calculate a modified internal rate of return. So what we have here is a nice simple example. We've got ourselves a 3-year project whereby we go through and invest funds at T0 of 2,500 and get cash flows at T1, 2 and 3. What I'd like you to go through and do, just to get you back into the habit of calculating your internal rate of return, is to go through and for this series of cash flows on this project, calculate an IRR using a discount rate of 5% and a discount rate of 10%, which should hopefully, with a bit of rounding, give you a total present value of 179 at 5% and 92 at 10%. So we'll put those in so that you can then check that you've got them correct before you go through and calculate your IRR. Have a go, see how you get on, then we can come back and revisit it in a moment. So there we go. How did you get on with that? Hopefully you went through and managed to work your way to get to those two MPVs that we gave you there. A positive MPV of 179 at 5%, a negative MPV of 92 at 10%. Just have a quick look, check the numbers, see that you've got those right. Yep, all good. Okay, one or two of you just hanging on a little bit there. Yep, all done, brilliant. Because what we've got then is we can go through there and work out your internal rate of return. So your IRR there should be at 8.4%. Remember, what we go through and do there is take your first discount rate, so if you like RA. We then go through and do MPVA divided by MPVA minus MPVB. So there, minus will go through there and give us a plus. And then we have there RA minus RB is what you go through and multiply your fraction by. So we've got now an IRR of 8.4%. And the assumption there is that any cash flows that we get, we are going to reinvest those at the 8.4% to give us a nil net present value. So let's just go through there and look at what happens if we reinvest those cash flows at the 8.4% and see what happens. So what have we got if we reinvest the cash flows at 8.4%? Well, your cash flow there at T1 was £500. Now, if we invest that at 8.4%, we're going to multiply by 1.084 squared because there's 2 years left on this 3-year project. So that will generate me £588. The cash flow there at T2 was there at £1,000, if memory serves me right, which now there's only 1 year left on the project, so we multiply it there by 1.084 for the year. In terms of your cash flow at T3, well, we can't really reinvest that at your IRR because that's the cash flow that we received at the end of the project and it's finished, it's done and dusted. So what you've got there is if we total that up, it gives me there 3,172. The overall return that we get on this project is there 3,172. What's that then as a percentage? Well, it should go through, if we equate it all up, 3,172 is going to be equal there to your 2,500 multiplied by 1 plus your return to the power of 3. Now, solving that, you should get, if you tap it on to your calculator, gives you there 8.3%, which I know it's ever so slightly out, but is approximately there your IRR. So what we've got there is we've gone through and made the assumption that we reinvest the cash flows at your internal rate of return to generate us the IRR of the project. But as we said, that's not the case. We're going to go through and invest those cash flows at the company's cost of capital. That's where MIRR comes in to help us calculate a modified internal rate of return. So to calculate your modified internal rate of return, we're going to have to use a formula. Now, the formula that I'm going to go through and give you isn't the one that's there on the ACCA formula sheet. I think that one makes it a little bit more complex than what is necessary, but we'll then go through and work that once we've looked at this scenario here. Now, to calculate your MIRR, we go through there and take the nth root of the terminal value of the inflows. So that will be there at the company cost of capital. And we divide that then by the present value of the outflows, which again is there at the company cost of capital. Once we've got that, we then go through and subtract 1. That's the formula that we're going to go through and use as we work our next example. What I do is add that formula that you've got there to your increasing list of formulae on your formulae sheet to help you go through and revise your P4 syllabus. The example here that we have in the material is asking us to go through and calculate the MIRR. So we've got the formula that we've just gone through and spoken about. What we need to go through there is look at the nth root of the terminal value of the inflows divided by the present value of the outflows, both using your company cost of capital, and then subtract 1. So what do we have here? Well, we can go through there, look at the project, and see there that it's a 5-year project. So there, n is equal to 5. We've got there our inflows for T1, 2, 3, 4, and 5. And what we need to go through there is work out the terminal value of the inflows, which is there at the company cost of capital, which per the question in the material is there at 8%. So there we're going to have to calculate the terminal value of the 6,500 at the end of the project. Well, now it's year 1, so we're going to have there to compound that up 1 year, 2 years, 3 years, 4 years. We can then go through and look at the actual outflows. We have there an immediate payment of 15,000, which is there at T1. So there, that's nice and straightforward to calculate the present value of the outflows. And what we have then is a further investment of 5,400, another outflow, which is at the end of the first year. So that there is at T1. So it'll be needed to discount back to present value, again at the 8%. So what we have to do here is, if I was to go through and calculate your modified internal rate of return, we're looking there at the 5th root of the terminal value of the inflows divided by the present value of the outflows. So what I go through and do there is just a couple of small workings to be able to calculate those figures. So what I'd start off with, first of all, is to go through there and work out the present value of the outflow at 8%. So there, what we have is we have an outflow at T0 of 15,000, and we have there an outflow at T1 of 5,400, which needs to be discounted back to present value using the 8%. we can work out there that totals £20,000. So that £20,000 is the present value of the outflows. We now need to go through and calculate the terminal value of the inflows. Again, that's going to be there at your company cost of capital at 8%. So what we have here is your cash flow at T1. We're going to compound up at 8% for the next 4 years. We then have there the second cash flow in T2, which will be compounded up by 3 years. Now what I'd like you to go through and do is just finish off the example. You've got there a couple of more cash flows to go through and work out their terminal value. Once you have that terminal value, substitute it into the MIRR formula and see what figure falls out. Good luck. So, how did you get on there? Not bad. Yeah, it just takes a little bit of thought, a bit slow to get into it, but once you've done a few examples, you shouldn't have any problems whatsoever. So what you should have gone through and worked out there is that the terminal value of the inflows was there at 34,193. I think we'd done the first two cash flows for year 1 and 2. The terminal values for the third year were 6,707. For the fourth year, 5,103. And then for the final year, whatever the cash flow is, that's exactly the same as the terminal value as it arises at the end of the year. Based upon the terminal value of your inflows at 34193, substituting that into your formula and working out your modified internal rate of return gives you there 11.3%. In terms of your decision rule, it's exactly the same as what we had with your IRR. If your cost of capital, which is here at 8%, so there our company discount rate, if that is less than your modified internal rate of return, if that's the case, we will go through there and accept the project. So having gone through and calculated our modified internal rate of return, we can then just briefly look at the advantages that there are, which can be there as a written part of any question. First advantage that you've got is that having calculated your modified internal rate of return, it eliminates the possibility of multiple IRRs. Remember, one of the disadvantages of your IRR calculation was the fact that if we had several IRRs, then it was difficult to go through and choose which one would be appropriate within our investment appraisal. The second advantage of your modified internal rate of return overcomes the other disadvantage that we had of IRR, in that IRR assumed that the cash flows were reinvested at the IRR percentage. Here, your modified internal rate of return assumes that the cash flows are reinvested at the cost of capital to the company. The third disadvantage is in terms of the ranking. We go through and rank our projects with respect to the MPV being the highest. Here, it's consistent with your MPV. If you rank your MIRR by the highest MIRR as your project appraisal, then you should get similar results to what you have with your MPV. The fourth and final advantage is the fact that it's a relative measure. Many non-financial managers struggle to understand MPV as an absolute term and what this increase in shareholder wealth means. But if we can show them what a percentage return the project generates, that is much easier for them to go through and understand. If you can go through and learn these four advantages, that should be some nice, straightforward, easy marks within the exam.